Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.
Tonight, inflation numbers for last month released today, and the CPI is now at a 40-year high at 8.6%, not seen since 1981. We've got that and more tonight on this Friday, June the 10th, 2022. Hi, I'm Andre Laborde, and welcome to Wall Street Wrap-Up for this Friday, June the 10th, 2022. Hope your week went well. Well, it's hard to look at May's CPI report released today and not be disappointed. The Bureau of Labor Statistics released this morning the Consumer Price Index for last month. Inflation rose year over year for May, now at 8.6%. That's the highest inflation rate since 1981, over 40 years ago. Gasoline is at its highest rate, according to AAA, and today reaching at $4.98 a gallon nationwide. And in California, gasoline in some locations are selling for over $9 a gallon. Food prices are up from last month. All food is up over 10%. Eggs are up 32%. Fish is up over 12%. Milk almost 16%. And coffee, I need my coffee, up over 15% since last year. Energy prices are up over 34.5%, which is the highest rise since 2005, when Hurricane Katrina landed on the Gulf Coast and oil spiked around the country. Gasoline is up almost 50% from last June. Used vehicles are up over 16%. Grocery prices have not seen a rise like this since 1979 during the Jimmy Carter years. It's certainly having an effect on consumer spending. According to a recent Washington Post George Mason University poll, they found that almost 90% of consumers are into bargain hunting for the best prices. And 0.75% of Americans have now cut back on going out, on entertainment, and on discretionary spending, and it's going to show in the economic forecast of coming up in the future. The Federal Reserve meets next week. The feeling in the stock market was that they'll be raising rates 50 basis points, or 50%, 0.5% for June, and also for July. But with these new inflation numbers, I'm thinking they're going to have to raise 75 basis points, 0.75%, or maybe a whole 1% interest rate for June, and probably for July as well, too. Many people were not even born during the late 1970s when Paul Volcker, who was chairman of the Federal Reserve, had to raise interest rates to 20% to break the back of inflation. If the Federal Reserve had only started raising interest rates earlier and not kept the punch bowl for as long as it had, we wouldn't be in the situation we're in right now. Well, it's a great lead-in because coming up tonight, we'll be talking with the founder and CEO of Case Capital Advisors, Kenny Pulkery. Now, possibly you may know Kenny. He's a financial commentator with the Fox Business Channel. With oil going up and inflation at its worst since 1981, what stocks do we keep? Which ones do we discard? A lot to discuss tonight with Kenny Pulkery coming up. But first, how did the markets do this week? Well, this week, the indexes all ended in a sea of red. The sell-offs all due to the hot inflation numbers released today. The Dow Jones had their worst week since January this year. And the S&P and the NASDAQ all ended the week for the 9th weekly loss. All 11 sectors ended in the red. And the NASDAQ ended over 3% today, down. And this week, the Dow Jones ended at 31,391, which was down over 4.5% for the week. And the S&P 500, they closed at 3,900, which was down just over 5% for the week. And the NASDAQ, they ended at 11,340, which was down a little over 5.5% for the week. Well, let's get to our guest tonight. Kenny Pulkery, he is the founder and the CEO of Case Capital Advisors. He's also a financial commentator for the Fox Business Channel. And best of all, he's here with us tonight. Hi, Kenny. Welcome to Wall Street Wrap-Up.
Thank you very much. It's a pleasure to be here. I'm looking forward to this.
Me too. You've done this for over 30 years. And the point that I know a lot of people have asked me, they said, Andre, I've never seen anything like this when it comes to this market sell-off. What are you telling your clients?
Well, it's interesting because I've lived through a number of sellouts, right? Over the 40 years, I was there in 1987. I was there during 2000. I was there during the crash of 2007, 8, 9. This is, while it's uncomfortable, this is not that. At least I don't think it is that at the moment, right? I mean, I think that it's going to be a little bit more volatile. I think people need to understand that. I think people don't need to make emotional decisions. I think my clients, people that I advise and help build portfolios for and advise on what they should hold, I've been telling them for the last 6 months as we moved into 2022 was that I thought it was going to be volatile. And so therefore they should position themselves. They should now overweight themselves in more, I call them big, boring, but beautiful names, large, multinational market cap names that are dividend payers, that are really core, solid holdings without necessarily selling or getting rid of any of your tech holdings, but just now not adding to them, right? Not adding to them until we find that we've hit a bottom, and to add new money to kind of the value and the more stable safety names. And they would include energy names, which has done very well, right? Energy's up 66% this year. Consumer staple names, things like Kellogg and Johnson & Johnson and General Mills, Procter & Gamble. You want them in financials in a rising rate environment. You want big financials as well as some of the super regionals. What I would stay away from are those really, the sexy high growth names that were so popular over the last 7 or 8 years are now not so much, right? And so we've seen what's happened to some of those names. But, part of being a wealth advisor and a wealth manager and talking to clients like that is also being able to listen, right? Being a very good listener, being able to understand what they're feeling or how comfortable or uncomfortable they are at any given moment, and then walk them through it. Because part of what I always find happens is that people make emotional decisions versus, smart longer-term decisions, just because they let themselves get caught up kind of in the anxiety of it. And that's part of that's really part of what I do.
Well, stocks usually trade on forward earnings. And in January, late December of 2021, January, they were trading at much more forward earnings. Now, we're going into the summer, we're in June, and those forward earnings have been decreased quite a bit. So are now good times to get those stocks that may have been looking too frothy in January?
There are certainly some stocks that have repriced, and they've repriced dramatically. Mm-hmm. And so I would also say I remain a buyer. I've been a net buyer, and clients of mine have been net buyers during this whole time, right? Without necessarily chasing or trying to get in every single day. You don't necessarily have to make a decision every single day. Sometimes doing nothing is the decision to do, and to sit back and to wait and build up the cash position. Now, look, yes, it's always great to look at names that have repriced, names that have come in significantly. But it depends on the sector, and it depends on those names, because I still think there's some downside pressure that's going to be on the market. So that's a conversation to have when it becomes specific. So on any down days, it's always a good time to buy names like Apple and Amazon, because I find them to be foundational holdings. But I'm not so sure that I would say that about some tech names, right? While I still own tech, I don't own any of that really sexy high growth, the Zooms and the Teladocs and the Shopify and Spotify. I own none of those. I never did, partly because of where I am in the life cycle and the risk scale, right? If I were 25 and I had 45 years to go, that would be one thing, but I'm not.
Like you talked about Amazon or Apple or others like that, is now maybe a good time to add to your position of that?
I would say yes, because that's what I'm doing in those names, right? I'm not buying. I tend to be a buyer when the market's weak. I'm not when the market's rallying, I sit there and I let it run because I'm invested, so I'm participating, so I don't feel like I'm missing out. But when the market sells off and I have the opportunity, I'll look at stocks. I do a lot of charting, so I look at stocks based on charts, and I can see kind of patterns and where they are, and I either wait because I identify the fact that I think it's still going lower based on what the chart's telling me, but I start to make a shopping list, right? But if you already own it, and then you want to buy it on weakness based on maybe what the chart's telling you, right?
There was an investor many years ago in the 1920s and 1930s named Bernard Baruch, and he always had a statement saying, always buy when there's blood in the streets. And
Right. And listen,
like
that's like
you were just
Warren
saying.
Buffett, who said you want to be a buyer when there's fear everywhere, and you want to be a seller when there's greed everywhere, right? And so that's the same thing. You want to be, I'm a buyer on weakness because that's the days where you get people that are fearful. Listen, the other thing that your listeners need to understand is the way that the market has changed so dramatically because of the role that technology plays in who can access the market, how quickly they can access the market, the number of venues where you can trade a stock, which only adds noise to the process. And one of the things a long-term investor needs to do is eliminate that short-term noise. If you're a day trader, you love the short-term noise because that's what makes the stocks move up and down daily. But if you're a long-term investor looking to build a portfolio, you need to eliminate the noise, and you need to focus on the fundamentals. And look, if Apple sells off 15 or 20% because people are raising cash because they're nervous, or insurance companies or pension plan companies need to raise cash to pay obligations, that's fine. The fundamental story in Apple hasn't changed, so therefore buying it down 15 or 18 or 20% is a huge win for a long-term investor, right? But if the stock is down 15 or 20% because fundamentally the story's changed, then I'd say stay away from it.
People have been cooped up for the longest time because of COVID. Now, that's good for travel stocks, but at the same time, gasoline has never been highest as it is right now. And when we started this conversation, I'm sure gas went up a couple more pennies per gallon since just you and I started talking. So I'm curious about travel stocks right now, and I'm thinking of hotels, cruise lines, airlines, such. What are your thoughts about those?
Where, high prices are going to cause people to sit back and rethink what they want to do. It now costs me nearly $800 to fly from Florida to New York.
Yeah.
That was a $150 trip a year ago. Now it's nearly $800 to fly from Palm Beach Airport to LaGuardia Airport. It's ridiculous. And so I think what's going to happen is people are going to say, do I really need to do that? Do I really want to do that? Because then on top of that, you fly to New York, any hotel, and you're talking about, the Marriott or the Hilton Hotel is going to cost you $350 just to walk in the door. And so ultimately, at some point, it's going to start to impact decisions that people are going to make, whether they're going to travel like that or whether they're going to travel more locally, right? Yes, gas is up. I get it. But people do want to go out, and they will make other decisions in order to, be able to buy the gas and go on that vacation. Then they're going to forego other things in order to be able to do that. But I got to tell you, I think in the travel section, travel sector, the airlines and hotels are going to start to feel that pressure. So I'm not a buyer of the airlines and hotels right now. I know there are a lot of people that say, it's going to be a great summer, and people making all kinds of plans. I think that's great. But listen, another couple of days like we had today, oil is going to be trading at $140 a barrel, and then gas is going to be that much higher. Diesel fuel is going to be that much higher. Jet fuel is going to be that much higher, and all those costs are going to get passed right down your throat.
Like you mentioned, diesel. Diesel is what runs commercial trucking. And to get commercial trucking from one end of the coast to the other, to Boca Raton, Florida, or to Los Angeles, California, you need diesel. And right now, refineries are now changing from diesel to regular gasoline. So that means the supply of commodities is going to be costing more. What do you think that's going to be doing on the economy?
Cost of diesel is going to go even higher than it is. And that's going to put a lot of pressure on transportation companies and then businesses shipping goods across the country. And what's that going to do to those prices? It's going to raise them, and they're going to try to jam those raised prices down your throat. And at some point, you as the consumer are going to go, I don't want it. I don't need it. I'm going to wait. I'm going to keep what I have. And so I think that is going to be part of the story that we see where the economy is going to start to stumble, right? Now, is it going to stumble really hard? I don't think Jay Powell is going to negotiate or navigate a soft landing at all. I think it's going to be a very hard landing, if you want my opinion, because not only is he raising rates, but we've got surging energy prices, which are going to take its own toll on the economy. And then you've got the reduction of the balance sheet, which is going to be a de facto also increase in rates. And so I think people need to just understand that. They don't need to get emotional about it. They don't need to light their hair on fire. They just need to position themselves, understanding that that's what's going to come down the pike.
We've got an FOMC meeting in June, and we've got another one coming up in July, and we've got a few more coming up toward the rest of the year. But It looks like they're baked in 50 basis points, 0.5%, for this coming meeting and the following meeting. Do you think that they're going to just keep going with 50 basis points, 0.5% at each meeting, or do you think that they're going to go, well, let's do them for the next 2 meetings and then hold off and see how we're doing and then go to the next step? Are they? I guess I'm asking, dovish or are they bullish?
No.
What do you think?
So I'm hawkish, right?
Yeah.
I'm not dovish because look, I think June is baked in at 50 basis points. I don't think they can do anything but. If they do something less than 50, it'll be perceived as negative. If they do something more than 50, it'll be perceived as very aggressive, right? So I think June next week is baked in. July, even though they want to tell us they're going 50 basis points, there's still 6 weeks until the July meeting. A lot can happen, and it's going to start on this Friday when you get the CPI report, and then Monday when you get the PPI report, and then you get the price, the PCE deflator, which is the Fed's favorite gauge. All those numbers are going to show rising prices, and at that point, the Fed's going to have to start to get more aggressive, and you're already seeing that. Right, you're already seeing James Bullard, Loretta Mester. These are all Fed members. You're seeing Mary Daly out of San Fran, John Williams out of New York, talking about the need for the Fed to be more aggressive to tame inflation. Because look, inflation's running at 8.5, officially 8.5%. I'd say it's probably closer to 10, but officially, let's stick with 8.5%. Interest rates right now are only 1%. If the Fed is really, really intent on controlling inflation, they got to jack rates up higher than what the inflation rate is, the same way that Paul Volcker did in 1980, 79, 80, 81, when he jammed rates to 21% when inflation was running at 13%. He had to jam rates higher to slow it down, to bring it to a stop, put the country in a recession to kind of normalize things.
You know, Kenny, it's a good
thing. Yeah. I think Jay Powell's going to be faced with that same problem because I don't think inflation is peaking at all.
Good point, Kenny, because there's a lot of investment advisors and a lot of people, a lot of investors that have no idea what you just mentioned just now. When Nicholas Brady was the, Fed Reserve Chairman, and then Paul Volcker came in, and then he had to raise rates so high to break that back of inflation. They've never gone through inflation. They've never been through something like that.
But there's that whole generation that are also now money managers who've also never lived it, and they've never invested in that kind of an environment. And so therefore, there's a lot of people need to learn a lot of things about the way inflation responds and what inflation does to the economy and what inflation does to investments. And so I think that's where, having a little gray hair actually helps.
I'm glad, just like me, Kenny, you and I both put it, we're all pitch black hair, and in the morning we just put the gray in the morning to give us that wisdom look.
Yeah.
After the July meeting, they may raise it, let's say, 75 basis points.
Listen, I'm in the camp that the Fed should have raised rates by 1 full percentage point in June and potentially again in July, because that would have shocked the markets, right? Because everyone's going, no, they got to go gentle, they got to go easy. Easy baloney. They need to shock the system because they spent way too much time stimulating the system. Last May 2021, when the CPI rocketed up through 2%, which was the target, and had been like at 1.7%, and suddenly went to 3.5% in one move. And so therefore, that was the moment where the Fed should have said, okay, it's now we've launched it. They should have started then because they could have done it easily then. They could have done 25 basis points starting last summer. We wouldn't be where we are today. And now we're at 8.5% and likely going higher. And so the Fed's going to be forced.
And not only that, Kenny, but as of June 1st was when they finally stopped with the purchase of the bonds, of mortgage and treasuries.
And they have been a buyer of last resort, right? And everyone knew that. Everyone knew the Fed was there buying it. So therefore, it was stable. Once the Fed pulls back, they're going to start reducing $45 billion a month started in June. They're going to get up to $95 billion by August. And so once they're not the buyer of last resort, there's going to be a void in bids in the Treasury market. And that's when you're going to see Treasury prices collapse even more and yields are going to go higher. And that's what then is going to be a challenge for the market and challenge for stocks. Certainly the high growth names for sure will continue to be under pressure.
So happy to have Kenny Pulkery. He's with Case Capital Advisors. Don't go away. We've got a lot more to discuss. We're talking with Kenny Pulkery. Kenny is the founder and CEO of Case Capital Advisors. Kenny, before we left for a break, we were talking about the Federal Reserve and whether or not what they're going to be raising interest rates and such are going to be. And I'm curious about oil and gas stocks, of which we discussed a little bit earlier. Goldman Sachs this week recently raised their price targets and a buy rating for companies like ExxonMobil, Chevron, ConocoPhillips. And I'm curious your thoughts on that because, yes, these oil and gas stocks looks like, and I'll use the term short term, they're going to be going up. But the way the Biden administration has a more of a, these kind of stocks are in the crosshairs with the administration. What do you think about owning oil and gas company?
I own them. I love them. I've owned them for a while. I've been hot on energy for, since probably November of 2021, where I started to say, energy is going to be the place to be in 2022. And look, the XLE, which is the S&P Energy ETF, is up 67% year to date when the broader market is, NASDAQ's down 25% and the S&P's down 18 or 15%. The energy has outperformed, and it includes those names that you said: ExxonMobil, Chevron, ConocoPhillips. You go through the list of Baker Hughes, Schwab, Halliburton. They're all in that. They're all in that ETF, and they've all acted very well. So I continue to be a buyer of those names. I continue to think that energy is going higher. I continue to think that demand is robust around the world. They kept trying to tell everyone, "Oh no, demand's going to wane." Demand baloney. Demand is robust around the world, and it's obvious by the way you could see energy, the way that energy is trading, and you hear the stories every day, right? How much in demand energy is. So, and now the Western sanctions have taken Russian oil off the market, which is only going to create kind of a global supply tightness issue when you take the Russian oil out. So it's only going to fuel energy to go higher.
So even if let's say if a viewer has, they may not have the kind of money maybe to buy the Chevron or the Exxon, maybe an XLE.
Yeah, an ETF. Yeah. So, it's funny because I play it both ways. I own the XLE, but I also own Exxon separately, partly because Exxon is one of those big, boring, but beautiful multinationals. That's a big dividend payer, right? They pay nearly 5% in a dividend, and it's a great stock. I love ExxonMobil. It's like American pie and ice cream, right? It's ExxonMobil.
America.
It's America. So yes, I like those names, and I continue to think they're going to do well, and I continue to own them.
Kenny, what's the best investment advice were you ever given?
I think the best investment advice was that you can't be emotional. And what happens when it's your own money, you tend to be very emotional, right? Which is why having someone to kind of be your checks and balances, right? Because I'll be the first one to tell you that, when it hit the fan in 1987, I was 26 years old. I had become a member of the New York Stock Exchange in 1985. I was kind of right in the thick of it. I had just gotten married. I had no money in an IRA or savings account because I'd spent it all buying a house and we had our child and all that stuff. But I watched as guys who were 50 and 60 years old on that day, on October 19, 1987, when the market sold off 22% and individual names were off even more, the devastation in their faces and how some of them got really emotional and ended up selling their holdings directly at the bottom. And then you saw what happened. The market just took off after that. Yeah, kind of churned for 2 or 3 weeks, but then it found stability and rocketed higher. I think what people have to understand is not to be emotional. If you have a portfolio that's built around a strong foundation that represents your values, that you know what you own and why you own it, then that's all you need to know. Then there's no reason to be emotional, and you should take advantage of the weakness. Now, look, I always like to say, because people can identify with this. When Bloomingdale's has a 30% off sale, everyone goes running into the store because how could I leave that shirt on the rack? It's off 30%, and they buy up everything. But what's interesting is when Apple goes on sale and it's down 20%, everyone goes, "Oh my God!" and they got to get out, they got to sell their Apple. It is exactly the wrong decision. Exactly the wrong decision. Kenny, but, people understand that. But people understand that, right? Because they know when Bloomingdale's has a sale, they run in and buy everything they can.
Kenny, those people who know me personally, one of my favorite sayings is that it's like a sale at Macy's. with the stock market sell-off. This is a sale. You just substituted Macy's for Bloomingdale's. If people didn't know better, they would have thought you and I talked before the show going on.
No.
God, let's coordinate. I promise our viewers and those people who know me, we didn't coordinate it.
No, but you and I are of that same generation, so we understand that.
That's right.
Right? We understand that. Now look, if you own junk in your portfolio and the market sells off, then I wouldn't be so quick to say, don't be emotional. Get rid of the junk that's in your portfolio in markets like this. Own good, solid, large cap names that are going to survive the instability at the moment.
Kenny, in honor of you, instead of saying there's a sale at Macy's, I'll now add Bloomingdale's to that as well,
Bloomingdale.
too.
I call it Bloomies.
Bloomies. Kenny, I can't believe where the time is went. I hope you come back.
I'd be happy to come back if you want me back.
I would very much so. That's Kenny Pulkery, founder and CEO of Case Capital Advisors. Thanks a lot, Kenny. Well, if you've got a question about finance or a comment about the show, we'd love to hear from you. Make it pithy, make it concise, and write us at Andre@wallstreetwrapup.info. Now look ahead for the market information for next week. But first, in 2017, George Clooney and Randy Gerber sold their Casa Amigos tequila brand to what beverage company? We'll have that answer in just a moment. Well, in 2017, George Clooney and Randy Gerber sold their Casa Amigos tequila brand to what beverage company? Diageo. The price, $1 billion. Well, and finally, Facebook has taken the final step to change its stock ticker from FB to Meta, META. The new ticker went into effect yesterday on Thursday. The company said the ticker and the name change to Meta Platforms reflects the company's move into the metaverse. So you may call it Facebook or Meta, but it's now officially changed. Now, coming up next week, with gas prices rising daily, we'll be talking with next week, the president of the U.S. Oil and Gas Association, Tim Stewart. Gasoline is going up so daily, it probably went up since we started the show. And diesel that transports cargo from one part of the country to another is going up even more. This, of course, shows up in the prices of goods we buy from grocery stores to retail outlets. Next week, the president of the U.S. Oil and Gas Association, Tim Stewart. Well, as a reminder, we repeat the show on Sunday mornings, but the best way, set your DVR so you'll never miss an episode. And that is our show for this Friday, June the 10th, 2022. I hope you enjoyed it. My thanks so much to my friend Kenny Pulkery for joining us this evening. But as always, it's you. We appreciate you for joining us and allowing us into your homes tonight. Remember, you can always follow us on all the social media on Facebook or Meta, YouTube, Twitter, and WYES.org. So, enjoy your weekend ahead. Have a productive week as well. I'll see you next week. Remember, for Wall Street Wrap-Up, I'm Andre Laborde. Remember, money never sleeps. Good night.
Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.